China just woke up. They are draining silver tonight, right now, while most people are asleep. While screens are quiet and markets appear calm, something is happening on the other side of the world. Not tomorrow, not next week, but tonight, a silent shift where physical silver is being pulled away ounce by ounce, and the price you see on your screen may no longer reflect reality. Because when one side of the world starts paying more and the other side hasn't caught up yet, it creates a window that doesn't stay open for long. And when it closes, the market doesn't ask permission. It simply moves. Welcome to the channel. This is where we slow everything down and show you what serious people quietly watch, while the rest of the world is distracted. And before we go further, let me ask you something respectfully. If you've spent decades working, saving, protecting your future, then do one simple thing. Subscribe to this channel, not for entertainment, but for awareness. Because moments like these don't come with warnings twice. And tell me in the comments, where are you watching this from today? The signal did not arrive with noise. There were no dramatic headlines, no emergency announcements, no official warnings. It appeared quietly, during hours when most of the Western world was not watching. In China, trading had already begun. The Asian financial system was active. Screens were live, orders were moving, and something was different. Institutional observers noticed it immediately. They did not react emotionally. They reacted analytically, because timing in financial markets often reveals intent. China's latest move did not occur during peak global trading hours. It did not wait for New York or London to open. It did not wait for maximum visibility. It happened during the Asian session. This detail mattered more than most people realized. Global silver markets operate continuously across regions. When Asia opens, it becomes the first major center to establish price direction for the new trading cycle. Europe follows, then North America. Each region reacts to what the previous region has already done. This sequence creates momentum, and momentum shapes expectation. China sits at the center of the Asian commodity ecosystem. Its industrial system consumes vast amounts of silver. Its factories require silver for electronics, energy systems, and advanced manufacturing. Its infrastructure development depends on reliable access to industrial metals. This demand is not speculative. It is functional. Silver is not simply an investment asset within China's economy. It is an operational necessity. When China's participation changes, global markets take notice. Because China does not act randomly, its resource management follows long-term strategic planning. Institutional participants understand this clearly. They monitor China's behavior carefully, not because of immediate price movement, but because of structural implications. Structural implications determine long-term direction. China's latest move introduced a shift in participation. Participation is the foundation of price discovery. Price discovery occurs when buyers and sellers interact freely. Each transaction contributes information. This information creates price stability. But when participation shifts, price stability becomes uncertain. Uncertainty changes behavior. Professional investors do not wait for confirmation. They observe early signals. They adjust positioning gradually. This process does not create dramatic price movement immediately. It creates subtle structural change. These changes often go unnoticed by retail participants. But institutional capital reacts quietly. They understand that overnight sessions often reveal the earliest signals of structural transition. Overnight sessions provide strategic advantage. Liquidity is lower, fewer participants are active. This allows large institutions to adjust positions with minimal resistance. They can act without drawing attention. This is why major positioning changes often begin during these hours. China's timing reflected this reality. By acting during the Asian session, it established the first signal of the new trading cycle. The signal would influence every market that opened afterward. Europe would observe Asia's activity. North America would observe both Asia and Europe. Each region would react accordingly. This chain reaction defines global price direction. Institutional participants understand this sequence. They do not view overnight activity as secondary. They view it as foundational. Foundational signals shape expectations before broader participation begins. China's move occurred within this critical window. It did not guarantee immediate outcome, but it changed the starting point. Starting points matter. They define initial momentum. Momentum influences perception. Perception influences decision-making. Decision-making influences capital flow. Capital flow determines price stability. China's structural importance amplifies the impact of its actions. It represents one of the largest sources of silver consumption globally. Its industrial demand remains consistent. Its long-term infrastructure projects require reliable material supply. Its economic planning extends beyond short-term fluctuations. Institutional observers recognize this consistency. They do not interpret China's actions as isolated events. They interpret them as strategic signals, signals that reflect broader priorities. When China adjusts its participation, It reflects calculated decision-making. This decision-making often anticipates future conditions. Future conditions influence present positioning. Institutional investors position themselves based on expectation, not reaction. They observe structural behavior. They evaluate risk. They prepare for potential adjustment. China's latest move introduced new variables into this evaluation process, variables that would influence institutional positioning. Institutional positioning shapes market direction. Markets do not move randomly. They move according to capital allocation. Capital allocation follows confidence. Confidence follows structural stability. China's participation contributes significantly to structural stability. Its presence reinforces confidence. Its absence or adjustment introduces uncertainty. Uncertainty does not immediately produce instability. It produces observation. Observation precedes action. Action follows confirmation. Confirmation appears through price behavior. Institutional investors watch this process carefully. They do not rely on opinion. They rely on evidence. Evidence emerges gradually, through price movement, through volume, through participation. China's latest move marked the beginning of this observation phase. Global markets would now respond to the signal, not immediately, but progressively. Each region would interpret the signal. Each participant would evaluate implications. Each institution would adjust positioning accordingly. This adjustment process creates transition. Transition defines the boundary between stability and change. Most participants do not recognize transition when it begins. They recognize it after it completes. Institutional participants recognize it early. Early recognition provides strategic advantage. Advantage allows preparation. Preparation reduces risk. Risk management defines institutional survival. China's timing demonstrated awareness of this structure. It acted during a window of strategic influence, a window where early positioning shapes future price discovery. Global markets would now absorb this signal. They would interpret its meaning. They would adjust accordingly. This process would unfold quietly, without dramatic announcement, without public confirmation, because structural transitions rarely announce themselves. They reveal themselves through behavior. China had already acted. Now the market would begin to respond. And those watching carefully would understand what the signal meant long before the rest of the world realized that anything had changed. The number on the screen looked stable. It moved slightly, up a fraction, down a fraction. Nothing unusual, nothing alarming. To most observers, it appeared normal, but experienced participants understood something important. The number on the screen was not the metal itself. It was only a representation, a reference point, a signal, not the reality. Because in modern commodity markets, silver exists in two parallel worlds. One world exists inside financial systems. The other exists in physical vaults, factories, and supply chains. Most people only see the financial version. Institutional observers watch both. And when the two begin to separate, they pay very close attention. This separation does not happen often, but when it does, it changes everything. Financial pricing is driven by contracts. Contracts represent agreements for future delivery. These contracts allow participants to buy and sell efficiently. They create liquidity. They allow price discovery to occur continuously. But contracts are not metal. They are promises of metal. Promises rely on confidence. Confidence relies on stability. Stability depends on alignment between financial activity and physical reality. When alignment exists, markets function smoothly. But when alignment begins to weaken, subtle signals appear. Institutional participants recognize these signals immediately because they understand a fundamental principle. Physical demand cannot be negotiated. It cannot be delayed indefinitely. It cannot be replaced with paper. Physical demand must eventually be satisfied with physical supply. China's latest move brought attention back to this principle because China does not operate primarily as a financial trader. It operates as a physical consumer. Its factories require real material. Its infrastructure requires real inputs. Its supply chains require real delivery. Financial contracts alone cannot satisfy industrial demand. Only physical silver can. This distinction creates structural importance. China's participation represents actual demand, not speculative positioning. When financial participants trade contracts, they are expressing expectation. When China acquires material, it is expressing necessity. Necessity carries greater weight than expectation. Because expectation can change quickly, necessity cannot. Institutional investors understand this difference clearly. They monitor physical flows carefully. They track movement into and out of supply chains. They observe warehouse inventories. They analyze delivery trends. These indicators reveal structural conditions, conditions that financial prices alone cannot fully represent. China's latest activity suggested adjustment within physical supply dynamics. This adjustment introduced uncertainty into financial pricing assumptions. Financial markets depend on predictable supply relationships. When supply relationships change, pricing models must adapt. Adaptation does not occur instantly. It occurs progressively. Institutional participants adjust gradually. They reduce exposure to uncertainty. They increase exposure to stability. This repositioning process creates transitional phases, phases where financial prices and physical conditions temporarily diverge. This divergence creates tension. Tension does not remain unresolved indefinitely. Eventually, financial pricing adjusts to reflect physical reality. This adjustment restores alignment. Alignment restores stability. But during the transition, uncertainty dominates. Uncertainty creates opportunity. Opportunity attracts institutional capital. Institutional capital moves carefully. It does not move emotionally. It moves strategically. China's role amplifies this strategic importance. Because its demand represents structural consumption, not temporary speculation, structural consumption creates sustained pressure. Institutional participants recognize this pressure early. They observe changes in demand patterns. They observe changes in delivery behavior. They observe changes in market structure. These observations guide their decisions. China's latest move introduced new observations, observations that required interpretation. Interpretation determines positioning. Positioning determines exposure. Exposure determines risk. Institutional investors manage risk above all else. They do not seek dramatic gains. They seek predictable outcomes. Predictability depends on structural stability. Structural stability depends on reliable supply. China's behavior influences this reliability. When China increases participation, supply availability changes. When supply availability changes, pricing expectations adjust. Adjustment creates volatility. Volatility reveals underlying structure. Structure determines long-term direction. Most participants focus on short-term price movement. Institutional participants focus on structural positioning. Because structure determines sustainability. Short-term movement can mislead. Structural movement reveals truth. China's actions reflected structural intent that would influence global supply perception. Perception influences institutional confidence. Confidence influences capital allocation. Capital allocation shapes market stability. This process unfolds quietly, without dramatic headlines, without immediate recognition. Because structural shifts operate beneath surface activity, only those observing closely recognize their significance early. China's move was not dramatic in appearance, but its implications extended far beyond immediate price movement. It introduced a question institutional investors could not ignore. Was financial pricing still fully aligned with physical reality? Or was adjustment beginning? Institutional participants would now watch carefully. They would observe delivery behavior. They would observe price response. They would observe capital movement. Each signal would provide clarity. Clarity would guide positioning. Positioning would determine exposure. Exposure would determine outcome. Because in commodity markets, financial pricing may lead temporarily, but physical reality always determines the final destination. And China had just reminded the market which of the two truly mattered. There is a moment in every market transition when nothing appears to be happening. The charts remain calm, the headlines remain quiet, the public remains unaware. But beneath the surface, decisions are already being made. Institutional capital does not wait for confirmation. It moves when uncertainty first appears, not because it knows the outcome with certainty, but because it understands the consequences of waiting too long. China's latest move created exactly this type of moment. It did not create panic. It created attention. Attention among the participants who mattered most, because institutional investors operate on a different timeline. They do not react to news. They react to structural signals, signals that indicate change before change becomes visible. These signals appear through behavior, through participation, through subtle shifts in demand. China's behavior had introduced such a shift. Institutional observers began watching more closely, not publicly, quietly. They observed order flow patterns. They observed volume distribution. They observed where capital was entering and where it was withdrawing. This observation phase is critical because institutional investors do not move immediately. They verify first. Verification protects capital. Protection ensures survival. Survival defines long-term success. The first response is rarely aggressive. It is cautious, measured, calculated. Institutional capital begins by reducing exposure to uncertainty. They do not exit completely. They adjust gradually. This gradual adjustment does not disrupt markets immediately. It alters internal structure. Structure determines future direction. China's move introduced a structural variable that required evaluation. Evaluation takes time. During this time, markets often appear stable externally, but internally, positioning shifts quietly. These shifts create imbalance. Imbalance leads to transition. Transition reshapes market stability. Institutional capital operates with awareness of this process. They do not assume stability will continue unchanged. They prepare for multiple outcomes. Preparation involves positioning. Positioning determines readiness. Readiness determines advantage. China's role adds strategic complexity, because China's demand is not discretionary. It is essential. Its industrial system depends on consistent access to silver. Its technological expansion requires stable resource supply. Its manufacturing infrastructure cannot pause due to market volatility. This creates sustained demand pressure. Sustained pressure influences supply perception. Supply perception influences institutional confidence. Confidence influences capital allocation. Institutional capital flows towards stability and away from uncertainty. China's behavior introduced uncertainty into global supply assumptions. This uncertainty required institutional reassessment. Reassessment does not produce immediate price movement. It produces strategic positioning. Positioning occurs gradually, without announcement, without visibility. Professional investors adjust exposure quietly. They increase allocation to stability. They reduce allocation to vulnerability. This process unfolds beneath public awareness. Retail participants often recognize transition only after it becomes obvious. Institutional participants recognize it early, because early recognition allows preparation. Preparation reduces risk. Risk defines institutional decision-making. Institutional investors do not rely on prediction. They rely on probability. They evaluate potential outcomes. They position according to likelihood. China's actions altered probability assessments. This alteration required response. Response began quietly. Capital began shifting subtly, not dramatically, but deliberately. This shift would influence future market behavior. Market behavior reflects capital movement. Capital movement reflects institutional confidence. Confidence reflects structural stability. China's demand represents structural influence. Structural influence cannot be ignored. Institutional participants understand this clearly. They do not dismiss structural signals. They respect them, because structural signals determine long-term outcomes. Short-term volatility may obscure structural change temporarily, but structural change ultimately defines direction. China's move had introduced structural uncertainty. Institutional investors were now positioning accordingly. They did not need public confirmation. They needed only sufficient evidence. Evidence appears through behavior. China's behavior had provided that evidence. Now, institutional capital would begin its quiet transition. This transition would not be visible immediately, but its effects would emerge gradually. Through price behavior, through supply stability, through capital flow, each of these indicators would reveal the market's true direction. Institutional investors understood this process. They did not seek immediate answers. They sought structural clarity. Clarity emerges through observation. Observation requires patience. Patience provides advantage. Advantage determines outcome. China had already acted. Institutional capital had already begun responding. The transition had already begun. And those watching closely understood that the most important movements in financial markets are never the loudest ones. They are the quiet decisions made early, before the rest of the world realizes that the structure has already started to change. Most people never see structural change while it is happening. They see it only after it has already reshaped the landscape, after the price has moved, after the opportunity has passed, after the explanation becomes obvious. But institutional decision makers understand a different truth. By the time something becomes obvious, it is no longer useful. The phase where awareness exists only among those who watch structural signals carefully. The phase where preparation begins before confirmation appears. Because confirmation arrives late, preparation arrives early. This difference separates reaction from strategy. Strategic participants do not wait for certainty. They prepare for probability. Probability is revealed through behavior. Behavior reveals intent. China's behavior had revealed intent. Intent does not guarantee immediate outcome, but it defines structural direction. Structural direction determines long-term stability. Silver occupies a unique position within the global economy. It is not only a financial asset, it is an industrial foundation. It exists inside electrical systems, inside energy infrastructure, inside communication technology, inside manufacturing processes. It connects financial markets to physical reality. When structural demand shifts, economic consequences follow. Businesses that depend on silver must maintain supply stability. Entrepreneurs must anticipate input cost changes. Investors must evaluate asset stability. Decision makers must prepare for structural transition. China's move introduced a signal into the system, a signal that required interpretation. Interpretation requires discipline. Discipline requires awareness. Awareness creates advantage. Advantage allows preparation. Preparation reduces vulnerability. Vulnerability defines exposure to uncertainty. Institutional participants reduce vulnerability early. They do not wait for public consensus. Public consensus forms after structural change has already occurred. Institutional capital moves before consensus exists. This movement influences market stability. Stability does not disappear suddenly. It transitions gradually. Gradual transitions are difficult to recognize because they appear normal. Normal appearance hides structural adjustment. China's behavior had initiated such adjustment. Institutional observers understood the significance. They began adjusting expectations. They began adjusting positioning. They began adjusting exposure. These adjustments would influence future market behavior. Market behavior reflects structural conditions. Structural conditions reflect supply stability. Supply stability reflects participation. China represents structural participation. Its actions influence global supply confidence. Confidence affects capital allocation. Capital allocation affects price stability. This chain reaction unfolds progressively, not instantly, progressively. Each stage builds upon the previous one. Each stage reveals more information. Each stage reduces uncertainty until structural clarity emerges. Clarity arrives through observation, not through announcement, not through speculation, through evidence. Evidence appears in participation patterns. Evidence appears in price stability. Evidence appears in capital flow. Professional decision makers monitor these indicators continuously. They do not rely on prediction. They rely on preparation. Preparation allows control. Control reduces uncertainty. Uncertainty defines financial risk. China's move had increased uncertainty temporarily. Institutional capital was now adjusting accordingly. This adjustment would shape future market direction, not immediately, but inevitably, because structural forces operate with persistence. Persistence overcomes temporary resistance. Temporary resistance may delay adjustment, but it cannot prevent it. Markets ultimately reflect structural reality. Financial pricing must align with physical conditions. Alignment restores stability. Until alignment is restored, transition continues. Transition creates opportunity, but only for those prepared to recognize it. Entrepreneurs who understand structural change gain advantage. Investors who observe early signals reduce vulnerability. Decision makers who prepare early maintain control. Those who ignore structural signals react late. Late reaction increases risk. Risk reduces stability. Stability defines long-term success. China's move was not an isolated event. It was part of a broader structural process, a process that unfolds quietly, a process that rewards awareness, a process that punishes complacency. Institutional participants had already recognized the signal. They had already begun adjusting. The broader market would follow eventually, but by then, positioning would already be established. This is how structural transitions unfold, quietly, gradually, inevitably. And those who understand this process early are the ones who shape their future, while others are still trying to understand what has already begun.